join us. And we'll be recording this, of course, to share it with the rest of the network as well. So I'd like to start by thanking our sponsors, Taft Law. They are a leading law firm with deep expertise supporting startups and venture funds and high growth techs. They've been really instrumental for the Viaka network. So I will start off by just talking very quickly about Viaka. We are a global platform that scouts, invests in, and supports the growth of exceptional MENA connected and diaspora founders, while convening a trusted network of founders, investors, and operators who are mainly across North America and London. And really, at the core of Viaka is access to capital, which is our angel network. It's a growing group of 80 plus active angel investors who co-invest in early stage, very high quality startups that we source through our city chapters, the various events that we hold, and of course, our extended scout network. Since launching last year, we are about to write our 12th check with one follow-on deploying close to $700,000 alongside leading US investors, including YC and Sequoia. Our investment activity is supported by a very strong sourcing engine that leverages our, wide global network of thousands of people and our 5 active city chapters in New York, San Francisco, Boston, Toronto, and London, where we host regular in-person events. So I encourage you all to keep checking our calendar of events, which is on our website. And one of the things that we've done really intentionally is make angel investing accessible. Our members can participate with checks starting at $1,000, which allows them to learn, build exposure, and invest alongside experienced angels in a very structured way. We also welcome young professionals to join the network. Please reach out to me. I'll leave my email for you. Reach out to me if you are interested in joining or would like to learn more about the Angel Network. Now, beyond capital, of course, we spend a lot of time helping founders actually grow, and it includes go-to-market support, introductions to investors, partners, and convenings like the MENA Rising Conference taking place in New York and Toronto once a year, where we bring together founders, investors, and operators in a highly curated setting. Now, in terms of our investing, as I said, we invest in early stage founders. They need to be exceptional founders. Tickets range between 25 to 250K per company, and we partner early to build long-term relations. We place very strong emphasis on co-investor alignment. We invest alongside very reputable investors. We are sector agnostic, so we invest in VC-backed tech-enabled startups that have the potential to scale globally with a focus, of course, on pre-seed, seed stage companies, and they need to be incorporated in the US. But one of the founding team members has to be linked to the MENA region. So that's it about Viaka. Over to you, Dima, to walk us through the agenda for today.
Sure, thank you, Reem. So in the previous session, if you were with us, we covered the role of angel investors. We talked about how angels evaluate and assess opportunities in early stage deals. Today, we'll go deeper into how to invest consistently, how to build a portfolio strategy, and what to track post-investment. Feel free to send in your questions in the chat. We'll also have time for a Q&A at the end.
And this will be an interactive session. So if you have a question, let us know.
Yeah. Okay, so we'll start with developing an investment strategy. Our goal is to invest with intention. I like to break down the strategy into steps, or the development of the strategy into steps. So step number 1 would be defining your angel allocation, deciding how much capital you are willing to allocate for angel investing overall. And this should be capital that you can afford to have tied up for a long time, and potentially lose given the high risk nature of the asset class. And I also advise on setting a follow-on reserve within this allocation. So not just initial checks, saying this is the total I want to invest and carve out a follow-on percentage in advance so that you can double down on the best companies in your portfolio. And we'll talk about follow-on investing in a bit. And this will help us set a realistic investment cadence. The second step is to set your check size. So to set a check size that can help you diversify. So not concentrating all of your capital in one or two companies. We want to build a portfolio of diversified companies. So one of the key and core best practices in angel investing is diversification. So the ticket or the check size that you are setting has to give you enough room to invest in multiple deals. The third step would be how many startups you want to invest in. So if you work backwards from your total allocation and your check size, you can estimate how many companies you can realistically invest in. And think of the investment duration as an investment period of 2 to 4 years. That's typically the investment period. I'll talk a bit about the timeline as well in a bit. So, with knowing your total allocation, your check size, the number of deals, we are starting to think of angel investing as a repeatable portfolio strategy rather than like one-off decisions. So, we want to be consistent in exploring opportunities. The fourth step is defining your approach. So, someone in the previous session asked if they should only invest in the field that they know, their area of expertise. We want to invest in areas you understand. That's one of the approaches that you need to consider, where you have strong judgment and you can build conviction, but you also want to explore opportunities from trusted co-investors, where you have access and signals coming from experienced investors in your network that offer you opportunities outside of your field. And third is looking into emerging and high growth sectors where you are learning and positioning for future upside. And the concentration in each is going to vary depending on your risk appetite and your financial position. So you want to invest where you have conviction, where you have trusted access, and where you want to learn.
And that's where an angel network becomes,
Yeah.
a good venue to do that as opposed to investing solo.
Exactly. And the final step, which is repeatable and ongoing, is reviewing and reiterating. So your strategy will evolve as you gain more experience. You're going to learn from the outcomes. You start sharpening and improving your process, and you'll also decide on what makes most sense for you. So if you need returns faster, maybe you need to be investing in more mature companies. If you can afford to wait on returns, you can invest in more frontier tech that has a bit of a longer R&D period. So this is where you start reviewing and refining the strategy. But if we follow these 5 steps, we can kind of get to a structured and repeatable process. So you're not investing randomly, but you're kind of building a system, right? Does anyone have any questions, or should I move on to the next slide? Okay, moving on. This is one of the most common questions that I get. Deciding on how much capital you're going to allocate to angel investing. I have to preface by saying this is not investment advice, but these are the typical ranges or like the standard ranges that investors usually dedicate their capital to in each asset class. And they will vary again depending on your risk appetite. So we know with VC, venture capital, it's an illiquid asset, it's a long-term investment, it has the highest risk, but along with it comes the highest potential upside. And usually angels work their percentage up over time. So they might start with 5% of their allocation, and then, depending on their portfolio performance, feel more confident in increasing it to 10, 15%. But typically, this is the dedication, and this is the point where you start budgeting for your angel investment activities. Okay. So moving on to the typical return profile and time. When it comes to venture capital and angel investing, returns aren't linear. So early on, we actually see very little to no return, sometimes even negative performance. But then as companies mature, value starts to emerge. And the majority of returns typically come later in the life cycle. Often we see a peak between year 7 to 10. So it looks like a J curve. So year 1, 2, and 3, there's flat return or no return at all or negative return. This is where you're deploying capital. This is your investment period. There are, fees associated with investing. There are early losses. There are companies that are still building momentum. So we don't typically see any meaningful returns between years 1 and 3. Years 4 and 7, we start seeing early exits or markups. We begin to see some traction, some early acquisitions and follow-on rounds. So this is where the valuation and the value of the portfolio starts increasing and showing gains. And then year 7 to 10 is peak return, where we typically see peak returns. This is where your breakout companies are going to have acquisitions, IPOs, and major value realization happens here. So this is where most of the returns are generated. Then years 10 to 12, we start seeing stabilization. The remaining companies will either exit or wind down. There's fewer events, like value creating events, so returns start to plateau. This is where you kind of start cleaning up, exiting the companies that aren't really going anywhere. Companies will start shutting down, and this is basically what the 10 to 12 year period looks like. The For angels, so this is a VC J curve, but for angels, it's slightly more dispersed than VC funds. But this is like the typical cycle that we will see, the typical trend that we will see.
Dima, a question here. I mean, today with AI, we're seeing things move so fast. And I mean, we see it in our portfolio. I mean, companies that we've invested in 6 months ago are already,
Yeah,
double, tripling in value. So do you
yeah,
think the curve still holds today, given what, the rapid developments taking
yeah.
in AI?
So you usually see, as an angel investors, you can see like exits earlier than VCs, because the VCs will typically wait longer, whereas angels have an opportunity to sell through secondary deals. They have opportunities to exit to VCs that want to come in at the growth stage, with rightly so, that with what's happening with AI, we're seeing so many more acquisitions. But if you zoom out, this is the trend. It might get disrupted, but we've only been in this, new stage for the past couple of years. But typically, I would say if you zoom out and look at your portfolio overall, this is just the nature of the. Sorry, I think someone's mic is unmuted.
Yeah. All right.
Yeah. This will always probably be the trend. I don't think there will be major disruption to it.
Yeah.
Okay. Any other questions so far? Okay, moving on. So with regards to portfolio construction, we need to have a portfolio approach to offset the risk of early stage investing. So we want to think of the asset class as a portfolio rather than individual deals. Angel investing isn't about average returns. It's about accessing outliers early on. The return profile is usually driven by very few companies in your portfolio, and most investments won't return much. A lot of them will fail. A lot of the startups will fail. Some will return your money like 1x, not that big of a return, but a small number of the companies should return the majority or the 5, 10x, above 2x returns. And I included a visual of the power law here. And this is what, typically happens in a portfolio where you have just a couple of companies become outliers and show you the biggest return. This is why it's important to diversify. So going back to the strategy and the importance of diversification. I would say starting out with angel investing, try to invest in at least 10 deals to be able to capture, one or two outliers, 10 to 20 deals. Ideally, you start building up a portfolio of more than 20 over time. And it's really about accessing one big winner or a couple of big winners that, give you the exposure to those returns. So we want to diversify across the number of deals, the stages, the sectors, and the founder profiles. It's super important.
So Dima, I mean, as you mentioned before, the angel investing, I mean, given the portfolio buckets, people, if they, have an amount that they want to invest, allocate. So they allocate 5 to 15% to angel investing. And then, of course, as they get better at it, maybe they can, increase that percentage.
Mhm.
So 10 start, so they decide this is how much money I want to invest this year in startups and basically divide it by a minimum of 10, 10 checks, let's say, to be able.
Not this year. I would say split it over 2 to 3 years.
Okay. So 10 to 20 companies over a 3-year period.
Yeah, I mean, it depends on, your financial position, the risk you're willing to take. I wouldn't advise writing all of your checks in the first year. I would split it over 2 to 3 years.
And do you recommend diversifying also across sectors like
Yeah.
fitness, health techs, all of that?
Yes, of course. Stages, sectors, founder profiles, geographies, solutions. So let's say if you are presented with three health tech deals, I wouldn't do all three. I would try to do one or two if you have a lot of conviction in investing in that one sector. Maybe you come from that background and you have the conviction. But yeah, you have to diversify across sectors, stages, founder profiles as much as you can. This is why I'm saying to spread it out over 2 to 3. Some angels do over 4 years, to make sure that you are minimizing the risk, basically.
So for questions, is it on mic or on chat?
You can ask,
Okay.
or yeah, go
Uh,
ahead.
yeah, just a quick one, Dima. Thank you. About diversification, you mentioned as well verbally now geographies, and I wanted to ask, is there a specific formula or structure when it comes to geographical diversification? So West, East, North America, Gulf, Singapore, etc.
So I would say it's there's no like set rule, but if it's a market that you understand, you can always make better decisions. Um, I wouldn't personally invest in a geography that I don't know, that I don't understand the dynamics of at all. So that also plays a big part in geography as well. But it really also goes back to the opportunity and the founders and the team that you are investing in and their plans for those markets.
Can you maybe quickly, like, for example, the MENA region, you're familiar with that, and then compare it to the US, for example. So we know in the
Yeah.
US valuations are much, much higher. The
Yeah.
ability to fundraise is, enormous. The market is enormous in the US. So if somebody's familiar with both markets, what would a diversified portfolio look like, for example?
So another factor to consider is that the time for exit in the US is way faster than in MENA. So if even if it is a more expensive deal, and you're going to get less equity for your buck, the exit timeline is shorter, so it depends on your priorities. Um, but if I'm comparing, it's like you're comparing apples to oranges. But I would say if you're familiar with both markets, do some deals here, some deals there, but it all depends on the team and your conviction and your due diligence. It's not just purely ticking the box of this is how many deals I need to do in each market.
And in the US, really, San Francisco can be considered a market, New York, another market, Boston, another market, and everything in between is also another market. It's so vast as well.
Yeah. Okay. And another factor, if we can move on to the next slide, is the follow-on investments. So, like I mentioned at the beginning, we should also carve out a budget for follow-on investing. Follow-on investment is when we invest additional capital in a startup that we've already backed with an initial check. So, this is where we're doubling down on winners. We want more exposure to the few winners and more equity ownership in the winners. So we want to try to invest again before the valuation gets too high and it jumps and VCs or later stage VCs get involved in the company. Um, so the goal in angel investing is different than other asset classes. We're not looking to outperform every year, but we're looking to generate those outsized returns over a long period of time through a few exceptional companies. And I just wanted to highlight an example here in the graph on the impact of angel investing. So, for example, if you invest $5,000 in 10 companies, so a total of $50,000, and one company becomes a big winner and has an exit and returns 20x, you get 100K back. But if you had a follow-on ticket in that same company, so the first time you invested 5K, the second time you invested 10K, so you invested a total of 15K, that 20x return gives you 300K back. So you're tripling your return because of the follow-on investment. This is why it's very important to make sure that you are looking out for follow-on deals. And of course, we're not, reinvesting in all of the companies. We're looking for the strong founders that have shown us exceptional execution, have a clear traction and momentum, have an ability to raise a next round, are building up for their Series A and growth stage funding, because this is where the angel investors can exit and make their returns. And positive signals. So positive signals from other investors, knowing that there is an intention or a pipeline of VCs that they are talking to and are interested in the company. These are the companies that we want to follow on invest in.
And
In ter-
angels, work closely with founders and support them. They get, a front seat to those signals as well, which is amazing.
yeah.
Lean.
Yeah, I have a question here. So, how this is initiated or triggered? So, of course, I understand what is the logic behind doubling down. Is it like triggered? So, Reem, in the instance where they have they're close to the company, I get it. They will see this, but outside this context, would I initiate this like myself? Would the company be looking again? Like, how does it work really in practice? And is there also my second question, legally, is it like,
Yeah.
how to say, the company, the founders, are they bound to accept that, instead of going for a big chunk, big check, to accept initially some, of these who believed in them earlier on? I
Yeah.
don't know if that made
So
their second question, but yeah.
Yeah, sure. So there are certain rights and terms that you need to make sure are in your investment agreement with the startup, and I'll cover that in the next section. You also should have access to reporting, and the founders should let you know they're intending on raising another round. A lot of the founders approach their investors, their existing investors that are already on their cap table before they go externally. So these are things that you need to look out for in the investment agreements, the reporting and the rights.
Here, thanks.
Yeah. Another point I wanted to make before we move on is how much allocation we are dedicating for follow-on. So the average allocation for follow-on should be around 30%. So if you're dedicating $100,000 for your bucket of angel investing, make sure that 30% of that is reserved for follow-on opportunities, because usually those deals are more expensive to access, because the startup should have grown and had some traction and an increase in value by then. Okay. So moving on to post-investment engagement, what happens after you've invested? Your role as an angel doesn't really end or shouldn't end after investing. Great angels support their founders by opening doors. They provide strategic input. They give them access to customers, to talent, to other investors. And if they have relevant value add and information, they give strategic advice. So, you try to support and be as responsive and helpful as you can to those founders. And in terms of tracking, we have two levels of tracking that we need to keep in mind. We have company level tracking. So you should be able to track the progress. You should be able to stay informed, so you can make those follow-on decisions. Like what you need to keep track of per company is, first of all, reporting, the legal documents, and the key updates. So in terms of reporting, you should get quarterly or annual investor updates, and this you should have agreed on with the founders when you've invested. Those include high level KPIs, so things like the revenue, users, growth, key wins, challenges, the burn rate, and the runway, so you can tell when they're going to need to raise another round. And legally, the key documents that you should always have is the safe kiss note, whatever equity agreement you have, the investment agreement that you have signed with the investors. Please make sure you read it line by line. There are a lot of resources and standard terms now that are very easy to look up, but make sure you understand these agreements and make sure you have pro rata rights. So this is your right to access follow-on. And it's not just only a right that's like in writing in the agreement. It's also much easier for a founder to try to raise at least part of the next round from their existing investors. It's extremely time consuming for founders to fundraise. So most founders do go back to their existing angels, especially when they are at an early stage, and inform them of their intention to raise a new round. And you should get key updates with regards to valuations as well, or new rounds that they've closed, and like the key terms, top level, even if they don't share the entire document with you. But what valuation the VC came in on, for example, how are they going to help them? What are the key rights that they gave that VC, and any ownership or dilution or cap table changes you should also be privy to. So changes in the shareholders and how much they own. Okay. On a portfolio level, if we can go to the next slide, please, Reem. You should be able to track the total capital that you've invested at any given point in time. So I would like start an Excel sheet, keep track of how much you're investing, the current value, the markups or the markdown. So I came in, I participated in the round with company X, the valuation was Y, and when they have an event and they send you a report, you can mark it up or down, the valuation, the number of active companies, which companies have failed, and which companies that you've made a follow-on on. You want to track how much you own in each company, how much the total investment amount is, save the last update somewhere so you can always go back to them, and the current status. Are they growing? Are they doing well? Are they stagnant? Are they at risk of shutting down? So this gives you like an overall picture of the performance of your portfolio and helps you make follow-on decisions, but also initial investment decisions, like who are you going to invest in next? How many of your companies are not doing well? How many are? Can you afford to recycle any of the capital? And how you're going to reiterate on your investment strategy. So those are the main things I would keep track of.
I apologize. I didn't, for some reason, the chat was not showing me the questions or people's like comments. We have a question from Basil Murad Dima. He's
Yeah.
asking if there's any rule of thumb for evaluating bridge investments. So, for example, in terms of runway or remaining time the company has, how do you typically decide, whether to
Yeah.
participate in a bridge round or not? This is a very good question.
Yeah. Very good question.
Maybe if you
Um,
like explain why do founders go for that option? Why do they raise a
yeah.
bridge round as opposed to like a full-fledged round?
Sure. So sometimes the founders are trying to manage or balance between managing their cash flow and the valuation, right? They don't want to give up too much equity at a point where they don't have significant traction to increase the valuation. And we need to keep in mind that with every round, founders are getting diluted, and it becomes very challenging for them if they get to later stages, and the founders realize they only own minority in the company after raising so many rounds, so many equity rounds. So it's usually the reason why they raise a bridge round is because they're trying to, yes, raise money now because they need it, but they don't want to give up too much equity at that point. I would say I don't think there's a rule. You need to evaluate if it's how risky it is. So you don't want to I wouldn't participate in a runway that is way too tight, and I don't have any visibility on the likelihood of them fundraising soon enough. Like you don't want them to dry out basically before they can raise a next round. If they are in talks with another VC or they are working on another round, and they have maybe a term sheet. So a term sheet is what comes before an investment agreement. A lot of VCs send you a quick one-page, two-page term sheet. This is a very positive signal that the VC is intending to invest. They just need more time because legal rounds sometimes take a lot of legal work, sometimes take up a lot of time from the VCs. So that would be a scenario where I would feel more comfortable. I would really try to assess how much of a difference is that bridge round going to make. Is it enough for them to make significant progress or not?
Yeah, and in general, when founders are raising because they're doing it for strategic objectives, then in general, this is a good time to double down on the investment. But if they're just doing it to stay afloat, to pay salaries, to tackle their depleting runway, then that should send an alarming signal. So where's this money going, and what are they doing in terms of execution, and where are they along those lines as well? So that's important also too, because We've seen so many, entrepreneurs just they fundraising is a full-time job for them, just so that they can keep the company afloat, basically.
Hi, Dima. May I ask a question?
Absolutely.
This is Rafia Merchant, and thank you very much to you and Reem and the Viaka team for putting these together. Super helpful. I myself am in the energy transition space and looking at renewable startups and climate tech and so forth. I have been seeing a lot of startups that are, you know, um, I don't know, maybe around the 3 to 4 year mark, which means that they have, they're like past series A, B, C. They've at least got 3 rounds under their belt, and a lot of them evaluating going public, either directly or via SPAC. If you might have heard the whole SPAC structure. And I find it interesting because I do know, wanted to hear your thoughts basically around that. Like, it feels that it might be premature, but at the same, and also the equity markets are so volatile. Why would you want to consider going public either directly or via SPAC route at such time? Um, but it seems to genuinely have legs, speaking with my investment banking friends, and would love to hear your thoughts. Is it a red flag when a startup that's around 3 to 4 year mark, which means they've got some serious momentum, when they start evaluating going public, um, is that a red flag that they are not able to get funding anywhere else, which is why they are looking for this dilutive, higher oversight type of financing?
I wouldn't say it's necessarily a red flag because it's very sector specific as well. So if you are talking about the energy sector, I don't personally have a lot of experience in that sector, but different verticals behave differently. And I believe they have to, before they go public, they would have to, send out some feelers. So I would look at that as well while you're doing your due diligence to evaluate the opportunity. I don't know, Reem, if you have any other thoughts.
I'm not experienced in that sector, but Rafia, happy to take this offline and connect you with the people who are active in this field and can give you, proper technical feedback.
That would be terrific.
And
Thank you very much. Thank
follow
you.
up follow up with you on this. Any other questions? So we covered how much we, should invest in a startup, Dima, 5 to 15% of the portfolio. Um, can we talk a little bit about valuation? I mean, we interviewed. I had a meeting with a founder who's just starting, and his valuation was 30 million. I mean, what is it with these numbers? Honestly, I mean, no traction, no experience. Can they just throw numbers like this? Where do we draw the line when it comes to valuations?
So with the AI wave, we've seen numbers, evaluations yeah, going off the charts, but we are seeing more corrections now. We are seeing a lot of like the AI wrappers, the solutions that aren't really able to build up any momentum or traction are closing down, and we're seeing more no's, but it's very typical to any frontier tech trend, and we've seen that before with other verticals, so it will correct with time, but the valuations have to, especially at an early stage, have to be justifiable to a certain extent, and whether you do that by looking at other comparables, like other similar products in the market, other case studies, opportunities where you see like a path to exit. That's those are like some of the ways that you could validate those valuations. But it also again goes back to your conviction in that team, that founder, that as well as gathering more input from co-investors. That also helps evaluate drawing the line of what's too much. But we will see valuations get corrected for sure.
So, I mean, for people who want to start with the with angel investing, and so, they're looking at early stage companies, what really matters most at the early stage? Should they like only trust exited founders, experienced founders, or can they take a bet on, first time founders? What's the most important thing to look at when investing in early stage?
So I would say knowing why you're investing is very important. Whether that is because the team has previous experience with an exit or operating and scaling products and solutions previously, or because it's a new founder that has a very deep understanding of the vertical. Those are both good reasons. And I would actually include those two profiles in my portfolio. I would do some, again, going back to the diversification point, do some founders that have some experience under their belt that had an exit that scaled the product, but also do new founders that have a really good understanding of the problem that they're solving for and have shown you insights that no one else has, and have a solid plan. I would diversify and do both.
Yeah. Another category are, people who have industry experience. They've worked, let's say, in the corporate world. They're older. They have decades of experience.
Yeah.
They've experienced firsthand the challenge in their industry or in the market, and then they got an aha moment. I want to build something to address this challenge. So you're, also investing in somebody who is seasoned within the industry. But then again, the risks there are, you can have a brilliant idea, you bring together a fantastic team. Also, when you're older, you have the resources and the network to build the product. But then the
Mhm.
challenge is in execution, building the
Yeah.
company, the go-to-market aspect. Can you talk a little bit more about this as well?
Yeah, but the average age of a successful tech founder in the US specifically is way higher than I forget the exact number, but I think it's like in the 40s, mid to late 40s now in the US, right? The college dropout story is really like an outlier and unique case that we see, but the average is much older because people can take the risk as well, and have the experience in managing maybe teams, or they come from the industry, which also helps. Again, diversify. Do some people that have experience in that field that are older, but also include others in the portfolio that don't.
Yeah.
I think diversification. If you leave with one thing today, I hope you leave with the concept of diversification of your portfolio, and really thinking of angel investing as building a portfolio and not just one-off deals or one-off decisions.
So when we're talking about diversification, there are some, let's say I invest in a health tech and then a fintech, and those are all solutions that, the average person can understand, right? But what if like you're talking about crypto, or for example,
Frontier tech, like new
tech,
tech.
or should people,
Yeah,
know nothing about these sectors, invest in them, or
yeah.
be adjacent to them? What's a good strategy?
I would say that depends on your risk appetite. and how much risk you're willing to take. Some angels say, no, I understand fintech, I understand health tech. I'm just going to do a bunch of deals, build a portfolio in the vertical that I understand. That's perfectly fine. That's just the approach that you are choosing. But if I were to build an angel portfolio, I would do some frontier tech or in upcoming new technologies. You might make the wrong bet at first, but as you start learning, this is also one of the best things about angel investing is that you're learning about new things. You're getting exposed to new tech and upcoming fields. You will start making better decisions. If you are extremely, happy to take risk, increase your exposure to frontier tech. Right now, with everything happening with AI, for example, people, there's a lot of buzz, and there's a lot of people throwing the AI word out there. But this is why, again, it's a benefit of joining. The benefit of joining an angel group is that you are co-investing. So if you don't understand it, someone else in the group might understand it, or there are co-investors, VCs, other angel groups that understand it and can help you in the due diligence process.
Yeah, I mean, this is critical for us with the Viaka. Maybe I can like just go through our selection, our process of for making an investment in Viaka. So we start with the deal sourcing, which can be through the referrals, the wider community. We have scouts all over inbound. We work closely with investors on, we share deal flow. So we have so many different avenues for sourcing amazing deals, and our team is continuously chatting with those founders. We do an initial screening. If we like the founder, we think they're onto something. That's when we bring in angel investors, sometimes up to 10 of them. And we do like a deep dive, a DD session, a deep dive where we scrutinize the tech, the team, the strategy, the go to market, and everything. And it's a great way to leverage the skills of the network, while at the same time it's a fantastic learning experience as well. And we try to make sure that we cover all aspects, the not just the understanding of the sector and the skills, but also how to build a viable company, the go-to-market strategy, the financial strategy, somebody assessing the team, etc. So we build a full picture before we decide, yes, we're going to go write a memo and then present it to the wider network. And that's where we invite everyone to come. And, we do a Q&A session where the founder presents. And then that's when they post, they send us their commitments. So there is a rigorous process that goes before we're actually, presenting the angels with the memo, and massive learning experience as well. And then once we write the check, there's also the post-investment support that you talked about, Dima, and that's the power of Viaka. We leverage, the thousands of people who are present in our network and within our reach through the 5 city chapters: New York, Boston, San Francisco, Toronto, and London. And of course, our extensive network in the MENA region. If there's interest in expanding there, or if they are from the region interested in expanding into Europe or the US, we can facilitate these as well. This is just a sample of the companies. As I told you, we're about to write our 12th check, so we're very excited about it. But those are some of the companies we've invested in. Teammates based in Dubai, Vessel in Canada, and the rest are here in the US. So, and as you see, that we really co-invested alongside incredible investors, and this is the first filter also for us. So if they've been vetted through those investors, then we're dealing with a high quality company as well. And a bit more on the deal sourcing, of course, through the scouts, the referrals, inbound, and then we have a targeted outbound. We're continuously, monitoring what's happening within the MENA diaspora community as well, the entrepreneurial community, and we try to get to those people as well. So if there aren't any more questions, I guess that's a wrap.
Thank
Thank you
you.
so much. This was, again, an incredible session. And thank you. Thank you, everyone, for joining. And Rafia, I'll be in touch with you.
Thank you.
Thank you, everyone.
Have a good afternoon. Bye-bye.
Hi.